Hey everybody, it's Uzi from the Option Selling Institute, and I just want to put out a quick video over the weekend, share with everybody what I'm looking at, what's been going on in the markets recently. I haven't done any videos recently. I've been busy with a lot of mentoring and coaching, so I've been a little bit occupied, and trading up, of course. But I wanted to put something out quick just to take a look at what's going on with the markets, where we stand now, and where we might be going. Um, by all means, I don't know where we're going for sure. We're going to have to let price action dictate that. Um, there's no way to know where we're going to go. We don't know how the markets are going to ultimately decide to move based on all of the different things going on in the macro environment, from tariffs to repercussions from other countries, to lowering inflation, like some of the administration's recent decision making is hoping to do. The price of oil will be affecting inflation and other costs. So that there's some definite positives down the road from what is going on with the actions coming out of the administrations. And right now we're just seeing a pullback. Now we were due for a pullback for the longest time. I mean, we had the most recent pullback, I guess, was August 5th of last year when we had that Armageddon crash. So aside from that, we've been going up straight pretty much from that date forward, and we were due for a somewhat of a pullback. So, is it occurring now in light of what's going on in the administration's actions and in world events? Possibly and most likely, but that doesn't mean that the bull market's over, or that the pullbacks aren't going to be just a regular 10%, 15% pullback instead of a bear market. So we're going to have to see what price action tells us. But from this point forward, what we can do is just look at some of the data coming in, coming out from various sources, and watch price action, see how it acts at certain price levels, key inflection points, and then trade around that. Now, I can tell you this, from in our Discord, we've been booking 10 to 15 profitable trades a week, even in all this turmoil. We did get assigned a few trades along the way because, like everybody else that was a premium seller in this market, especially selling on the put side, or put anything related to puts, put credit spreads, put ratio spreads, any type of situation like that. Some trades have obviously taken heat. We've been able to close trades though that have bounced back or weren't deltas that were close enough to the falling markets to have been challenged. But by all means, we do have a couple of assignments and we're managing them. But the point is that, we've been booking some solid trades even in this turmoil. The trick though is to try to, wiggle your way out of positions that are underwater now, either for a break even or for small profits, or we'll try to get out of the small loss. So far, we've been doing well by booking profits, and we're managing the ones that are have been assigned or that are close to being challenged or underwater. But this is the time of trading when real traders emerge, right? The gamblers, the people who were selling puts on stocks that they really didn't want to own, but said that they wouldn't mind owning when price got to those levels or fell further, are the ones that are complaining and crying about what's going on in the market right now. Right, as of now, it's just a regular pullback. I'll go through the charts in a minute, but so far we're just down 10, little over 10% in the SPY, definitely more in the Qs and IWM. I mean, the Russell, the small caps are hurting, but overall, so far, on the S&P 500, it's a regular pullback until it's it shows up to be something different. But let's get into some of the charts. Let's just take a look at what I'm looking at, and we can always adjust our decisions or what we think we're seeing as time goes on. But for now, obviously, no one has a crystal ball. But let's just take a look at some of the data that did come out. So I found this on the internet on X, and it's put out by Ryan Dietrich. So kudos to him for putting this out. So it would be very rare if we went into another bear market right now, based on what he posts in this illustration, where um, in the last so we haven't had three bear markets within 5 years. That's what this chart is basically showing. That within a 5 year period, we've only had, I believe, a couple of times where we've had three bear markets within 5 years. So to have another one would be very, very rare. And right now, we're working on the most recent bear market, which was, I guess, in 2022. So, we're 3 years away from that right now. And this just says that the average time in between bear markets is three bear markets is 6.7 years. So it would be very rare to get one now. Matter of fact, that's what this is saying. There's never been three bear markets within 5 years. You can see the closest was 5.4 years. Um, Actually, I'm wrong. Pardon me. This is a difficult chart to read. Basically, it says though here another bear market would be extremely rare. To get three within 5 years is very rare. So the average is 6.7 years, and the mean is actually 6.7 years. So according to this, again, very rare that we get another bear market to show up within 5 years. Now, the next chart I want to show you was put out by Bank of America. And what this says is that in this most recent downturn, that big money has been buying just like they did previously in September of 2022 and in January of 2021. So you can see these three largest spikes occurred 2021, 2022, and the most recent one was just now, March of 2025. So if this is any indication that history will repeat itself, that this is a time frame where the bigger money is stepping in and the downtrend, or if you want to call it that, the recent downtrend will start to reverse itself. So let's take a look now at the four major charts that I kind of look at. You have the S&P 500 on the upper left. You have the triple Qs on the upper right. These are all, by the way, daily time frames. Then you have the IWM on the lower left, and you have the diamonds on the lower right. So let's start with the upper left quadrant. And what I want to show you here is pretty cool actually. So this is the daily chart of the S&P 500, and you can't see all of it because I was trying to maximize the space here, but you can see at the 23.6 retracement, Fibonacci retracement is where price decided to turn around from its downtrend and head back up on Friday. But what I also want you to note is that price never got to the ascending trend line. And again, you can't see where it started, but I believe I started this coming back all the way from the August 5th lows. And what you have is a pullback of just 23.6%. Actually, this is from the 2022 lows. So from the 2022 lows, October 2022, it's pulled back 23.6%. And not only that, but we did have from this double top, we had an equal move, which coincided pretty much exactly with this space in between the 23.6 and the ascending trend line. So this was a great spot for bulls to step in, okay, especially in a strong uptrend. I noted above here, anytime you get a pullback that only gets to the 23.6 or 0.236, whatever you want to call it, usually indicates a very strong bull trend. So, and it coincided, like I said, with the equal move from the top, the double-headed top here, to where price should have gone for a price target. So those lined up pretty well. And what we saw on Friday was not a hammer candle, but I'd call it a pseudo hammer, where we opened, we traded lower a little bit. We did not trade to the lower price point of Thursday. And, the bulls kept it alive, kept it moving forward, and it was able to close above Wednesday's highs. So that's a positive. That's a positive as far as building off of this reversal. I would have liked to have seen on Friday a gap down to possibly the trend line or even below, and then a hammer, which would have been nice to, well, it wouldn't have been a hammer, it would have been just an engulfing possibly, where it would have closed above Thursday, but gapped down on Friday. I would have liked to have seen that better for a flush, but I'll take what we got. And what we did get, though, which was nice, is we didn't get a gap up, because if that would have occurred, I believe price would have wanted to fill that gap, which would have given the bears another chance to push us even lower. So the fact that we opened up within the range of Thursday, traded lower, never penetrated the lows of Thursday, but did close above not only Thursday, but also above Wednesday, is actually a great sign. Let's look at now the Qs on the upper right. Now, this ascending trend line, you can see from in the chart, it starts way back, but you can see that price completely broke through that on a fairly heavy volume day down below here, you can see. And it also was a long red candle. So on increased volume and the big red candle, we got to break right through that trend line. It spent another day heading lower, just a little bit, before it tried to bounce, failed, and then we get here on Friday. Now, this particular chart obviously has much more headwinds to go through because it has to get back through this trend line, which we're going to see if it serves as now resistance, where it once served as support, as you can see. It may now turn into resistance. If we can get through this trend line and then maybe do a little bit of a pullback test of it. So, that would look something like this. We break up through, we come back and test it, and then we try to start a little bit, build a little bit sideways and drift higher. That would be a positive. So that's what I'll be looking for in this upcoming week. If we take our eyes over to the lower left quadrant, we can see the IWM also, it's been the weakest of all three. It broke through its ascending trend line, which was support, as you can see. It did have a look below and fail for the bears, where it got back above the trend line. It stayed that way for the bulls. One more look below and fail here. It bounced along it a couple times before it finally fell through. Looks like maybe the end of February, and it then just fell out of kind of fell out of the sky to where it turned around on Friday. Now this one doesn't look as positive in the sense of the S&P took out the highs of Wednesday. Friday's candle on the IWM did not take out the highs of Wednesday. It only took out the highs of Thursday. So we're going to have to see how the IWM acts this week, it being the weakest of those particular three. And then if we take our eyes to the lower right quadrant, looking at the diamonds, again, what was once a trend line of support failed. It broke through, came back and retested, and then fell right below the 200-day moving average. And you can notice, by the way, in all of these charts, we are now below the 200-day moving average on all of them. As you can see, these brown dots are the 200-day moving average. Now, one thing I wanted to mention on the IWM, what we have to be careful of is we might have a death cross going on here where we have the 50-day moving average in yellow crossing the 200-day. So let's see if in the next couple of days to 2 weeks or so, if this 50-day moving average cannot penetrate the 200-day moving average and curl back up. And what it's going to take for that to happen is price is going to have to come up pretty strong and pretty quickly for that 50-day moving average to not penetrate. So we're going to have to get some type of a V type of a rally in the IWM to keep this yellow line from just coming right through the 200-day moving average. So let's keep an eye on that. But let's get back to the diamonds for a moment. So the diamonds came through the 200-day moving average like the other three indexes, and it also did not take out Wednesday's highs. It only took out Thursday's highs. So we're going to have to see how the diamonds and the Dow 30 act again, obviously this upcoming week. Let's see if we can get above Wednesdays and then take that 200-day moving average, take it on and see if we can get above that 200-day moving average. That's obviously the best case scenario for all these indexes. Let's get back above the 200-day moving average. So let's take a deeper dive into the S&P 500 for a quick second. I noted it on the chart before, but it was kind of small. We can see it clearer here now. Price never made it to the ascending trend line, which does go back. Like I said, I believe this is December of October 2022. Then we have all along the way some other pullbacks, and you have these dips here. But it never made it to that area. That was the target based on previous touch points where it bounced off of it and began another rally. So we're going to see what happens again. I would have liked that gap down into that trend line and then a reversal, but let's see what we've got going on this upcoming week. Now, this was the chart that I actually posted on Thursday on Twitter before the Friday morning opening. Now, this was Thursday night. I don't forget what time it was, but I had posted that this is our target area, hoping for a gap down on Friday because we were way oversold, as you can see. Like the other times when we were oversold, as you can see, we bounced right from these levels, and we are there again. And I posted this Thursday night, and then I want to show you what happened on Fridays. The next chart is Friday, and here's the day of the move higher. So we never got to that trend line. We moved higher. Good, it's a good thing, like I said, we didn't gap up because then we'd have a gap to fill on the downside. So we can move now and build off of this by going sideways and trying to take out that 200-day moving average and form some type of a base above that, something we can work off of going forward and see how these, again, some of these changes like the tariffs and stuff like that affect things or not. One good thing is we did have inflation data come out this past week, which showed inflation is dropping. Prices of eggs are coming down again, like has been talked about on the news for the longest time now. So, certain things are starting to come down. Interest rates have come down. So house buyers are happy about that. There's not, there's at least they don't have high interest rates to be dealing with me. And the housing prices have not really come down that much, but they might come down a little bit um, too in time. So we'll see how that goes. Let's take a look at the next chart, which is the Qs. And I wanted to show this, which was pretty cool. Now, again, you can't see where I started the Fibonacci lines. Pardon me on that. But what I wanted to mainly show you was that we pulled back to the 38.2 Fibonacci level, whereas the S&P came back to the 23.6. This came back to the 38.2 and bounced right off of it, okay, which was a nice sign to see because, again, anytime you can get a pullback that only comes down to the 23.6 or the 38.2 Fibonacci retracement levels is considered a very strong trend. So this might just be a typical pullback, not a bear market, not a 20% correction, but just a 10% plus correction in the S&P, a bigger correction in the Qs and IWM because they are more tech related and tech populated. So that's why you're getting a little bit more of a pullback there. And we needed it, right? I mean, look at all these stocks that are just AI related or software related. Some of even the robotics related, we're kind of going crazy. So a lot of them needed a pullback and a cool off period. And I just think that that's what we've been seeing. But again, we're going to have to let price action dictate where we're going. I don't have a crystal ball, but I'm happy to just share what I am seeing with everybody. And let's trade this market together and let's take the good with the bad and don't let the price action of our stocks, define us because if you're a real trader, you're gonna sit through drawdowns in your career. Only the traders that got into the business recently are just kind of spoiled by seeing stocks go up every day or every week or every month or every year. I'm trading 27 years now. If you're gonna trade long term, you're gonna see sell-offs. You're going to see pullbacks. You're going to see bear markets. If you run and hide and cry and scream, then this is maybe not something that you're cut out to do. You have to be careful with your sizing. You have to only use a certain percent of your buying power in your positions, and always leave some money left over, a dry powder, so that when you get these type of days, and if you have positions that have gone deep underwater, you can either dollar cost average or put on new trades to offset some of your paper losses and unrealized losses until those stocks can recover. But all the while, you can sell covered strangles, or you can sell covered calls on the positions that you are in that were assigned and lower your cost basis until you can turn it into a profitable situation or at least a break even. All right, so let's go over some of the trading action in my Discord this week. We closed 13 trades for winners. We rolled, I believe it was 3 trades, and we took a couple of assignments. And we're managing as best we can with all of the different option strategies that we have at our disposal to wiggle our way along the way. So yeah, and these are all trades that are either indices, stocks, or futures. So we closed this futures trade for a 77% profit. That was a strangle. Then we closed the XOP ETF. For that 100% on that call, a naked call, 100% on this covered call on NVIDIA. By the way, we had a great trade on NVIDIA. We wheeled it for the week. We bought shares and then we sold and immediately sold a covered call. So we did a buy right on it. So we closed the shares for 5.2% in a week, and we were able to keep 100% of that premium on the covered call. So that was a sweet trade. We did a covered call on some of the shares we were assigned on Datadog, and you can see the rest of these profit premium capture profits here. We did 100% on an XBI put credit spread, which was part of an iron condor. So we're closing, like I said, 10 to 15 profitable trades a week, and rolling or dealing with the ones that are being challenged in this environment. and we're keeping our head above water, and we're just hanging on for to see where this market's going to go next. So if I can help anybody out with their trading, or if you want to trade with me, you want to get an idea of what we do in my Discord, I welcome you guys to come check us out. Here's a special I'm running right now for anyone who wants to check us out. It's a 3-month special. It's 10% savings, and it's going to get you access to all that we do. It's going to give you access to, let me just highlight some of the things for you. All of the futures trades that we do, which are options on futures, some zero DTE. We trade the indexes, we trade earnings. We have no losses in earnings this particular period, and we've only had 3 booked earning losses since I started the Discord almost a year ago. So you get about 40 trades a month, give or take. And we have a high win rate. Some people will say win rate doesn't matter, but it sure does matter, especially if you talk about keeping profits and in sports, right? If you don't have the high win rate, you don't go to the playoffs and you can't win the title, the World Series or the Super Bowl. So you have to have a high win rate, I believe. It's not everything, but you certainly would want to have a high win rate than not have a high win rate. So we have a great high win rate. Yeah, and we do, like I said, we do options on futures, stocks, indexes, and we trade earnings pretty aggressively, both pre-market, pre-report and post-report. Every now and then we do some zero DTE, and I give actually some spec trades too along the way. So here's the special. It's like I said, 267 for 3 months. It's savings of about 10%, and that should give you an idea of a good amount of time to get an idea of if it's for you. And if not, there's no contract. You can cancel at any time. But by all means, give us a shot. Let us show you how we do things in our Discord, and go from there. So here's the link. I'll post it also in the description below. But this is how you can access that exact discount deal, and hope to hear from you guys. So this is Uzi signing out. I wish everyone out there good luck this week. I hope you all make profits this week and get out of some of your positions that have been haunting you or hurting you. And let's make some money together. This is Uzi signing out. Have a great rest of your weekend, everybody.